YouTubers, welcome to the Independent Investor for Saturday, what is today? April the 18th. I won't get too much into the technical side of the market. The markets, I think now the last 2 weeks have rallied, been the best rally in about 70 years, I think going back to 1930 or something like that. I still continue to believe that this is still a bear market rally, and eventually it will turn around, test the new lows, or go up, down to make new lows. But that being said, you kind of got to watch the market. I did add a little bit to my long positions last week. Again, kind of disappointed because what I've been making on my longs, I'm kind of losing on my short positions. I closed out one short position last week at WD-40, WDFC. I had a small profit on. I closed out one or two others that I had a loss on. And I closed out some short calls, again mixed, some real loss, some with a small gain. But again, it's been kind of a wash again for another week. It's hard to trade with the market kind of going down and rapidly back up. I'm more of a trader that likes to buy a position and keep maybe for 6 months to 10 years if I still think it's a good investment. But one thing we do see is the market is getting very narrow. So what I mean by this is the NASDAQ is outperforming the S&P, and the S&P is outperforming the Russell. And we can see the NASDAQ now just being driven really by a couple stocks. And I should have caught this and did a trade on it, but I didn't. And that's Amazon. Amazon, as you know, is probably a 500 billion plus market cap company. Typically companies of that size might go up 8-10% a year, and we've seen it. You can see the candlesticks here. It's almost like it was an IPO type stock. It's gone up 20% just in the last week or so. So that has a huge influence on the NASDAQ. We're seeing that, of course, that's one of the FANG stocks. You can look at Facebook. Facebook's been rallying, and we can have a look at Google. Google's came back quite a bit, but most of it's really been driven by Amazon. So one way of comparing this, it's called a Fibonacci retracement. Fibonacci's come up a lot in technical analysis. If you forget what your Fibonacci numbers are, you can just Google it. Pretty straightforward. But if we go to the Russell, which is very broad, this is the Russell 2000. So it's 2,000 companies, which probably captures 95% of the U.S. market capitalization of stocks. And I just put a Fibonacci retracement on this, and from the bottom to where we are now, we've had about a 35% retracement. So 100% retracement would be back to the peak. So it's came up 35% from the bottom. Now you compare that to the S&P 500. Now we're reducing it just to 500 stocks, which are going to be 500 larger cap stocks. We've had almost over a 50% retracement. More than what I thought we would have, but not on historical. And then we go to the NASDAQ, which of course has your FANG stocks, has, you know, Amazon, as I mentioned. We've had a retracement of up to almost approaching 60%. So the NASDAQ has outperformed. So that's what I mean by a narrow market. And typically narrow markets happen towards the end of a bull market, as everybody, a lot of retail investors start buying the popular names. And you talk to most young people, what are they buying? They're buying Apple, they're buying Amazon, they're buying, and that's not necessarily a bad thing, but too much. In a good bull market, you want a couple, like you want a couple hundred stocks or something moving, or a couple sectors, not just technology. Maybe you want biotech or industrials or something driving the market. So to me, that's still kind of bearish. And I think I talked about the death cross, the 12-month ROC. I think they're still showing, and the 12-month ROC did come up a little bit, but it still hasn't got down to the -20, and it's still quite a ways from the zero line. So I'm still not convinced that this is a new kind of, say, bull market. Of course, I could be wrong. Happens a lot. But I think we will roll over and possibly see new lows. And it's like people are just ignoring, like go back to my February 4th video where I started going to cash. They seem to be ignoring a lot of the bad news coming out and focusing on, you know, Trump saying they're going to start to reopen the economy. We know in Hubei province now, people are kind of back to work, that type of thing. And then there was Gilead Sciences, was it Reserve as a possible drug for this virus. Now that's not a vaccine, that's just to treat the conditions, and it was a very small study, and I've actually owned shares in that company in the past. So again, it just seems like people are just really looking at any good news, and you had a lot of people that thought, geez, I got the bottom in, I'm not going to buy, you know, we're going to go to new highs. But when we look at the reality out there, it just doesn't seem to jive. Look at all kinds of economic data. One thing is oil prices. If we are turning around a little bit, we should start seeing oil prices come back a little bit, and they're just continuing to dive. I mean, if planes are going to start flying, people are going to start driving back to work. We know there's hardly any, actually I'll get to something in a minute on that, but let me just bring up this is the, oh sorry, that's the US dollar index. So this is oil. We were trading, as I talked about in other videos, 56 to 55 up to 60, kind of in that range. We had the spat between Saudi Arabia, Russia, Russia trying to put the frackers out of business, all that type of stuff. Supposedly came to an agreement the other week, going to cut 10 million barrels per day, which is a lot. But it really, everybody got excited and started talking about buying oil stocks and, you know, like your Suncors and things like that. I was hesitant, didn't touch it. Again, just going by the charts and not really seeing much movement out into the futures, which I'll show too. But we can see now, that news, we had a little spike. We got up to 27, but now we're down to 18. So again, we're at 30, 40 years low on oil, and copper is probably about the same. So we're not seeing, in my opinion, enough to justify, and even if everything went back tomorrow, everybody's back to work before this city go back to last September, there were still a lot of signs in September before everybody knew about this virus that the market was getting expensive. And now we've only had, what, 15–16% correction? And back then I would have said we probably needed a 20–25–30% correction just to get back to historical norms. Now I don't think we will ever get back to historical norms because, as I've talked about with the Federal Reserve banks printing money, people are going to keep, and that might be one thing that's driving it too. It's just, what else are you going to do with your money? And there's even talk now, we know the Fed has gone and bought corporate debt and other things that they've never done before. And there's even Yellen, who was a former Fed chairwoman, talking about buying stocks. So once that happens, like pretty much all bets are off, and we don't really have, is United States willing to give up the capital markets and turn it over to the Fed, which is basically turning it over to the government. That proposition alone is quite scary. And if that happens, they'll probably just end up with a market like Japan, because there won't be any price incentives or that to know what to differentiate kind of one company from another. So, and talking about oil, let me just bring you, there's one thing you can quickly look at.